Hey guys, so as per popular request, the topic you wanted to cover today was how to grow a small trading account of approximately 10K. So this will probably be a multi-part series because obviously there's a lot to cover, and today the markets are moving pretty heavily, so I got to kind of get back to my trading as well. But I want to be thorough here, obviously, and I don't want to kind of leave any stone unturned, so to speak. So starting off, obviously, the one of the biggest problems that small accounts have is that they don't really know how to allocate capital effectively because they have to take too much risk in order to try and grow a small account. And that's the primary source of why most smaller traders or fundamental investors fail. They're forced to over leverage based upon their account value, which is a huge detriment, obviously, because you can't really grow fast enough, and most people want to chase that dragon of growing, very very rapidly, not understanding that the probabilities aren't often in their favor. So when we look at growing a small account, the typical path that happens. This is from my course materials. I'm not going to show too much of them, but this is an example of poor risk management, and I've actually seen this happen numerous times where um, you know, you double your account a few times in a row and get lucky, and then you keep on using the same process recurringly, which elicits eventually a maximum loss, right? The same decision-making process that elicited a large gain is the exact same one that elicits a massive loss. And so, for example, sorry to call out one of my students, but Harry, if you're watching this, I apologize. But for example, one of my students, Harry, he went from under 10K to 150, 60K roughly in about 4 weeks. Um, just taking, like risky trades, short-term trades, weekly out of the money call options. It was permanently on Palantir, if I remember correctly. It was during COVID when Palantir ran from like, I think it was from like 12 or 15 to 40 or whatever before that pullback. Let me see if I can find the chart on Palantir. Palantir chart. Here it is, guys. Go with the weekly chart. So it would have been somewhere around here on the chart. And so he caught the move over here from there's some like like 15-ish or so to like 33, and then it ran up to like 45 ultimately before coming back down. But the same process that allowed him to make a lot of money on the way up over here. I think he stopped trading it over here, and then he bought some calls somewhere around here, and then as it pulled back, obviously they lost all their value. So the same process that he used to make that fast money is the exact same process that cost him his entire account value, pretty much. And so I always go back to that story because it's a common story that I've heard many times where you take a lot of risk at the onset. Your hope is that you try and double or triple or quadruple your account from like 10 to 20 or 40 or 50K. And then you say to yourself, once I'm at 50K or I'm at 100K, whatever the number may be, I will then start trading more responsibly. And the problem is most people don't get there. And obviously, once they do get there, they feel godlike because the euphoria is just coursing through their veins. They have they're they're just feeling very good about themselves. Everyone's been there. Well, I assume most people have been there when you've made a lot of money in the market very fast. I know I have when I was younger, and I'd make a lot of money very quickly, and and what would happen is I'd feel kind of very cocky, and I would do stupid things. I would take more risk than I should have, perhaps, right? But the point being is that ultimately, if you don't follow a stringent risk management protocol, you typically end up either just failing off the bat and losing whatever you put in off the bat, or you end up having a path kind of like this where you make a bunch of money very fast. You feel great about yourself. You feel really hyped up. And then you ultimately watch it crash and burn. And then you feel extremely depressed because you realize how much money you've pretty much burnt up. And most people in this situation, let's assume you have no savings perhaps, and maybe your job doesn't pay very much. Most people in this situation don't really have a backup plan where they can go and get more capital. Their access to capital is very limited overall. So that's a huge detriment to growing a small account is having the wrong framework to manage your risk overall. And when we think about it from that perspective, you really want to size your positions very, very small at the onset and test out your limits and see kind of where you're going right and wrong. This is where journaling comes into play, obviously, right? So I should maybe add here that journaling or the power of journaling, right? Journaling your trades, documenting what happened in a position, right? And by doing that, you're going to look back and see, okay, like what has worked over time and what has not worked over time. So again, like I obviously don't have a small account to trade here to show you guys, right? And I'm not going to do a challenge. Like I see many people trying to do these challenges where they apparently have a lot of money, but they're going to do some kind of challenge to elicit viewership on social media, which is not my intention here whatsoever. I don't care about social media at all. But the point is that if you want to grow a small account, you have to obviously be introspective too as to what decisions you made in the past and where those are leading you to, right? So I can pull up a journal and show you guys kind of like an example of how a journal looks. And if you want a journal yourself, a trading journal in Excel, I can give you one. Just DM me over Discord, because this is my own personal journal that I give out to my students. Let me just find it here. Here it is. Let me sure I'm not giving you guys my personal journal because that's private, obviously. So here we go. This one's clear, I think. Yes. All right, so I'll share over here with you guys this journal. So it has a few different tabs. This is what kind of like your journal should look like essentially in Excel. And again, it can take many different forms. You can probably use a vibe coding app if you wanted to like plot. You can say, hey, build me a trade journal like in Excel, and it'll probably do something similar. But basically, you have all these different parameters here. This is part of the trade tracker where you can kind of set objectives and put them in here, and it'll tell you pretty much what has to happen in order for you to get there. It'll show you how realistic it is overall. I don't use this myself very often because it's kind of like it's frivolous. It's just kind of like, okay, like if I want to get to a certain goal, how do I get there, right? The one that I use more often is this one right here, where you're going to have different trades here. You put your trade date in it, right? Your expiration date of, and again, we're talking in the context of options here typically, right? Like I'm assuming that most of you guys are trading options here, not trading stock. If you are trading stock, it's much harder to grow a smaller account probably because you're going to be limited in what you can actually buy. And the gains will be so minute that they won't really add up enough, right? The power of options is where you get the leverage required responsibly, obviously, to grow a small account into something that's perhaps substantial enough to elicit consistent cash flows through perhaps dividends later on, or covered call selling, or credit spreads, for example, or iron condors, whatever may have you. And so you want to record, obviously, the ticker, whatever the position is, a call or a put. The strategy could be like, butterfly call spread, butterfly put spread, for example, the strike price, number of contracts you're buying, the average cost per contract, the stock price at entry, stock price at exit, and then the average price per contract that was sold, essentially. That'll give you naturally a profit or loss. It'll also tell you what your initial investment was, the percentage gain or loss, and then you should have sell targets, especially if you're buying numerous contracts. Now, with a smaller account, you might not have, first, second, and third sell targets, for example, right? You might only have one contract, in which case you're buying that contract and you're selling it for a profit. And when you're out of it, you're out of it. That's it. But as you scale up and get larger, obviously, you could then have perhaps 2 or 3 or 4 or 5 contracts or 10 contracts, at which point you're going to have certain targets upon which you'll sell. And as I always say, de-risk your position, right? And that's not actually a word, but de-risking is the process of taking risk off a position when it goes in your favor to elicit less of an emotional reaction to the overall outcome of the position, right? And so you might have a max loss target as well, right? Typically what I say is I'm willing to cut a trade at 50% of maximum loss, assuming that I sized large enough that that's my target. Or I'll say, you know what, I'm happy to zero out a trade where if the trade goes to zero, it's not a big deal at all. And then obviously you record your delta exposure, your IV at entry, and your ID at exit as well. The reason why it's important to record these metrics is because if you record them, you'll understand where you're going right or wrong. For example, if you're buying when IV is very high, and again, you can record the historical volatility as well. A good practice is really just to screenshot your option chain, right? So, like for example, let's say that I'm looking at a given option chain right now. Let's go to just NVIDIA for the hell of it, right? So if I'm looking at NVIDIA, I would just look at a position and say, okay, I'm buying a trade, I'm buying a, whatever, a call or a put right now. Let's look at for next week just for fun. So what I would do is let me share my screen with you guys too. So what I would do is I would screenshot my option chain, right? So I would screenshot this. I would drag and drop it onto my notepad in my, I use Mac, right? So I'd screenshot this, for example, then drag and drop it onto, let's say, a notepad. And now I have all the data that I require to put my journal later on. Because if you're trading, actively during a given day, you want a time to go and put all these metrics in. But what'll happen is that you can see pretty much, what was the delta of a contract, for example. Let's say I'm looking at next Friday's like 210 call options. Ironically, they're not showing the Greeks here, right? Let's go to, like, for example, 205 for next Friday instead. So the 205s right now have a delta of 0.415. I'll put that in my journal, right? If I was using a spread, for example, I would say, okay, 205 to 210 or 205 to perhaps 215, in which case I'm long 0.415, I'm short 0.172. I would then put that number in my trading journal, right? You'd obviously note the implied volatility last. What happened on a given day perhaps is also can be useful if IV is expanding or contracting. And then obviously look at the historical volatility, right? Because if you're paying far above, if you're paying if you're buying a contract when the IV is far above the historical volatility, what you're doing is you're paying an inflated premium, which adds a lot of risk to your overall position. Because what has to go right for you to win a trade, right? So what has to go right for you to win a trade? And I'm going to say this with using options. So one, you have to be correct. To be correct directionally, right? I.e., buy a call, stock must go up, and vice versa, obviously. Two, you must be correct on timing, right? Options expire. So you have to be correct within the time frame of the option expiring, essentially, before it expires. And then beyond that, you have to be correct on magnitude of move. Because you're paying a premium for the option, you need an actual move in excess of the spot price moving, essentially. That's a bad way to phrase it, but you need pretty much the underlying asset to move oftentimes more than what you paid for the premium to monetize it, to make a profit, essentially. So if you buy, for example, out of money call option, let's say you bought the over here on the NVIDIA chart, let's say you bought the 205 call for 370 or 380. Spot price right now is 201, right? So you're $4 and change, or almost $4 away from being at the money on this 205 contract. Plus, you paid a premium of almost $4. Therefore, your break even at expiration is 205 plus, let's call it 380 for argument's sake. It's 208.80, right? So you need to be correct on magnitude and move. The underlying asset must move enough for you to make a profit. And keep in mind, you're fighting numerous different variables, right? You're fighting time decay, you're fighting volatility, perhaps contraction, if you're buying an option. If you're selling an option, you're fighting volatility expansion, perhaps, right? If you sell, for example, a credit spread and the IB goes up, that would typically elicit a loss, perhaps, depending on what happens with the underlying asset as per how it moves directionally. So again, you get kind of a frame of reference for how to think about documenting your trades by screenshotting your option chain and then putting all these variables into your journal. And again, it sounds very tedious, which it is, yes. But again, no one said this is easy, right? If you want to progress, you have to measure what you're doing. Otherwise, you won't really know where you're going right or wrong. You're just kind of flying blind. So it's the same. It's the same as anything in life, pretty much, right? If you're going to the gym, for example, and you're not documenting what you're doing as per like how many sets, how many reps, what weights are you using, perhaps what your diet is like on a given day, how much sleep you've gotten. We have all these efficiency trackers now in life. You have the Apple Watch, you have the Oura Ring, which tracks everything that you do pretty much, right? Your heart rate and whatnot. So again, that's for health, but in a similar vein, by documenting your decision-making processes and also your line of thinking, right? So going back to the journal again, there's a space there that says notes as well. And so after you put in all the different variables, you can say adjustments perhaps, right? Like so you can say, for example, roll to a lower strike on a pullback, 275. So like maybe for NVIDIA, the example there would be, okay, if NVIDIA breaks below 200, I'm going to maybe roll my 205 down to 200, for example, because you want to stay within range as you approach the expiration date. If you're hanging on or adding to these losers, right, you might be down in a position. You might say to yourself, oh, you know what? I bought it for 380. Now it's at $2. It's an even better price, right? But you're adding to a position that has a lower probability of hitting, which is why it's cheaper, right? So you want to kind of think about it from that perspective and understand why it's a bad idea oftentimes to add to a losing position, especially as it pertains to an option trade because they expire. The shorter the duration, the more this applies. Longer duration trades, like during COVID, I bought some Exxon Mobil call options. It was the $50 strike price call option. That we're at around $62 a share. I bought them for 2 years out, and I paid like $13, like a very nominal amount of extrinsic premium on those contracts. Like the true value was about $12, like 62 down to $50 is 12, right? And I paid about $13 roughly. Anyways, after COVID happened, XOM went down to like 35. My options went from 13 down to like under $1, I think it was. But I had 2 years of time on those contracts. So mentally, I wrote them off. I actually added some to that position, right? I got my average cost down. I don't remember the exact cost was. It was like maybe like $3 or $4, I believe. And then when it recovered back up within the 2 year time frame, it went past 60 again and past my original entry price. And the contracts traded for like 13, 14, $15, ultimately pushing as high. I think it was like 17 or $18 before they expired. So when you have more time, it's a very different, I guess, set of rules because you're not fighting the clock. When you buy an option that expires today or tomorrow or Friday or next week, you're fighting the clock because you need for a lot of things to go in your favor very quickly before you lose money, essentially. Anyways, I won't delve too deeply into that topic. I think you guys understand the thought process here. But again, the whole reason why you document your trading is because you then have a bunch of series data to show what's happened outcome wise. And then you go back through it again. And with my students, oftentimes, those that actually want to take the time, I'll spend like an hour here and there with them monthly to go over the journals and see where they're going right or wrong. And we pretty much find through observations, very, very low hanging fruit as to what to stop doing, i.e., you're only buying, 0.25 delta or lower contracts, which means they're too far out of the money, which means they're harder to monetize. So even though you might be winning the odd trade here and there and hitting like a nice big like 5 or 6x or perhaps, you're losing like 90% of your trades. Therefore, it's not really a good tenable process to use for the objective of long-term profitability, right? Or you might see that someone's, for example, buying only when IV is very elevated, and they're buying single leg contracts, not using spreads, for example. I love using spreads. You guys know me. Spreads are amazing because they mitigate your time decay, theta. They mitigate your volatility exposure, vega. And obviously, you're capping your gains, but you're also reducing your cost basis, right? Again, going back to that NVIDIA position that I posted in, or I guess put it over here. It doesn't really matter, right? For next Friday. So I mentioned like 205s are 380, right? So you can buy these for 380, but you could sell, for example, the 210s for $2.20. So now you're reducing your cost basis from 380 down to $1.60 by selling these contracts, right? What are you doing? You're capping your gains at 210. You have a $5 wide spread, risking $1.60 overall to make $3.40. On a 10K portfolio, you're essentially risking 1.6% of your portfolio to make 3.4% maximum upside. That's over two times potential upside on the trade, right? Now, it doesn't sound very sexy to most people, but they're not like, oh, sweet, I can make $340 in the next 8 days. Amazing, life-changing money. No, that isn't the objective, though. The overall goal is to have a recurring process over time and understand it takes time to grow a small account in the same vein that it takes time to build muscle in your body, right? Most people, I remember I was in the sauna, like I think it was last year sometime, and these four kids walk in and they're talking about, I've been working out for the past, a month or so. I haven't seen any results whatsoever, blah, blah, blah. And they're complaining about like just lack of progress and just like saying like, yeah, man, I should do steroids or whatever. And I'm like, you guys have been working out for a month and complaining about progress. I've been working out for like 23 years now, and like I'm only where I am today, 23 years, but it takes time to get where you want to get. Everyone just wants to speed run whatever it is they're trying to chase without understanding that part of the joy of any endeavor is the actual journey to get there, right? The end goal, like most people tell you that have had immense success in life, the end objective, when you achieve that goal, you feel kind of empty inside because you're just like, okay, like I hit my objective now, great. Like I play the piano, and when I tackle a very hard piece and I finish it, I feel fulfilled for a little bit, but then I'm like, okay, well, what's next, right? That's the same way that people feel when they hit a certain milestone financially or a certain milestone in their physique, perhaps, whatever maybe could be a career. It doesn't really matter what it is. The point is, um, you want to think about the journey to get somewhere. So slow and steady is the way to go. But oftentimes people will just chase that fast path, and that's what often destroys them, right? You might chase that fast path and you might make a bunch of money very fast, kind of like my student Harry did. But then what happens? You lose it all and you feel very empty inside because you're like, okay, well, now I have no ammunition now to go back and maybe even if I did learn from my mistakes, I don't know how to really apply that because I don't have any capital anymore, right? So, anyways, I can go off on tangents here and there. We're already half an hour in roughly. Um, Let me go back to here, right? So I want to say as well, right? So the power of journaling, we covered that. The math of survival, asymmetric loss versus gain. Again, this is where you can have two different strategies essentially, right? You can have a strategy of, for example, very, very high probability of making a profit, but a very, very small profit. An example of this would be, as you guys have seen, perhaps Captain Condor, David Chow, taking these risks where the reward is very, very small, essentially, the probability is very, very high. And so you might look at, for example, an option chain and say, okay, well, and a question that I ask myself personally very often is, if I would not buy this position, then perhaps should I sell it? Like if I'm thinking in my head, I wouldn't buy that contract, it's going to expire worthless. Then the reverse line of thinking should be perhaps, or could be perhaps, would it make sense for me to sell that position, right? And this is where you get into the kind of quandary of like, do I focus on high probability, low profit setups? Or do I focus on lower probability, high profit setups, for example, right? And I think you need to find a happy medium there. Like, there's no one answer to this question, right? Because, for example, let's say that I tell you, okay, well, next Friday, what's the probability of NVIDIA hitting 220? Based upon the current market analysis, based upon the option pricing, the delta here denotes roughly an approximate 10% probability of us hitting 220 by next Friday. Therefore, you might think, okay, well, why don't I sell this contract? I could do, for example, a 5 wide spread, sell this to 225, and I'm collecting like $30 of profit with a 90% probability, right? It sounds like okay, right? For one, $30 won't move the needle on your account whatsoever. Even on a 10K account, that's a 0.3% gain, right? So 1/3 of 1%. I mean, sorry, 3/10 of 1%.
texted
and
the
essentially,
lady
well, the mic is open right now, guys. Let
for
me just
11
mute that.
o'clock.
Mute
Ordered some
everyone.
coffee
If I do that,
and go over there.
someone's
Just
mute.
sitting here watching the market shit itself and making $1,157 in 3 hours.
You made that much.
Hey, windmill. Your mic's open. There we go.
Good
Oh no,
job. Keep going.
how
Keep
do I mute
don't,
again?
don't
Fix that,
lose
guys.
it. Keep it in there. Keep
Sorry,
Oh,
guys.
that's all right. Yeah, you can mute man. That'd be awesome. I forgot what the mute button is. Anyways, what was my line of thinking there? I was talking about the low probability. I mean, sorry, high probability but low profit, right? So again, making $30 on your account of 10K over the course of 8 days isn't really exciting overall. It's a very slow grind to do that. And the problem is that even like one loss here will wipe out many similar gains, right? Let's say, for example, you make $30 9 times, right? So $3 profit, but then on the 10th time, you lose 470 because some news breaks and NVIDIA pops 35 points in like a matter of a couple of days, right? Well, you just wiped out all your gains in one fell swoop. So the only real way to look at this using options is to find asymmetric setups. That meaning you're risking a very small amount for a potentially much larger payoff. And the question you need to ask yourself there is like, if I wouldn't sell this position, then I should probably buy it, right? Like, would you want to be selling, at the money credit spreads on the call side right now? We're trading near recent lows on NVIDIA at a key support area of like 200. The answer probably is an unequivocal no, in which case you want to pretty much look at the opposite of that and say, you know what? I'll take a stab at a long position. I'll buy the 5 wide call spreads for what is it right now? It's like, it went up a little bit in value since we've been talking. Maybe you got in for 160. I want to buy them for 160, for example, right? Maybe you set mentally in your head a stop loss at 80 cents. So if, for example, we sell off in the next, couple of days, it goes down to $80. You say, you know what? I hit my loss threshold. That's it. I'm out of the trade. That doesn't preclude you from taking a new trade that has more time on it, perhaps, right? Maybe you take a loss of $80 and then you still have a similar thesis that NVIDIA will push higher in the next month or so, right? Maybe then you look at, instead of the June OPEX, you look at perhaps the July OPEX, right? And you move over about a month to 38 days. Fine. Over here, guys, right? Obviously, the similar trade would cost much more money, therefore eliciting perhaps not a very favorable asymmetry of risk, but this is where you can use different strategies, right? For example, you can use like 205 to 220, which is what? That's like 980 minus like 460. So you're at like $5.20 roughly on the debit there. So you risk pretty much 520 to make like almost $10 overall credit. That's like 2-to-1 risk reward roughly. Or maybe use a butterfly instead. You select a second contract there. Now your debit goes down to like $1.20 roughly, and you go up to 235. Maybe you're risking like $3 to make $12, for example, right? In which case you have $4 or 4 units of upside per unit of downside, essentially, right? Or 4 units of return per units of risk, essentially, right? So different ways of kind of thinking about it. But the key thing is to be consistent in your overall decision making process, not deviate. Like I remember one of my other students, Andrew, this kid, him and I went over, and I say kid, he was like 28 years old, whatever. But we went over his journal. And Andrew, if you're watching, sorry for sharing this again as well. But no one knows who you are, so it's kind of irrelevant. But he would have trades where he has like he's like risking like 2 grand whatever to make 3 grand or something like that, and like over and over again. And then you have like one trade which is like 25 grand risk, right? So I'm seeing his journal, and I'm like 2 grand, $1,800, $1,500, $2,400 risk, whatever, right? Like two and a half, 25 grand, right? So again, like you see these anomalies, and I'm like, why did you make the decision there, right? And you lost $18,000, right? It's like, okay, like why did you make the decision there? He's like, oh well, you know what? Like I was hot, I made a bunch of money off the previous 5 trades. I was feeling good, so I saw a good setup. I took a lot more risk. I wanted to kind of like accelerate my process overall and accelerate my returns, right? What did he do instead? He erased like his past like 15 winners or whatever they were, and you're back to pretty much where you were like a month and a half or 2 months ago, which is very demoralizing because now all of a sudden you're saying, okay, I'm starting from a place where I was at 2 months prior. My progress is pretty much, it's almost like playing a video game where if you guys recall playing like on the old like Nintendos or PS1 when you had little cartridges and you'd save your game on these little discs or whatever. And then, if one of them broke or someone took it out and like it didn't work anymore, you lost all your progress, right? What happens? You're very demoralized overall. So your psyche is very important, which we'll discuss at a different juncture. We're already at 35 minutes in. Let me make sure I cover all my points here, and then we'll do some Q&A. So yeah, so the point there was, again, you want to look for asymmetric setups, small risk for much larger reward, or alternatively, you could look for perhaps, very high probability setups where you have very, very small gain with a much, much larger loss potential, perhaps. Like, again, like 0-day iron condors, perhaps, or monthly iron condors, or, if you're selling, for example, like iron butterflies, like all these strategies, they have asymmetric or negative asymmetry of risk, right? Like you're risking a lot to make a little, essentially, which for a small account, you need the opposite of that. You need to be able to make a lot of money on each trade. Each dollar should have potential to double perhaps in value or triple perhaps in value off a given trade, right? So good to think of it from that perspective. The more money you have, the less risk you need to take as well, right? Which is why after you get to a certain point, you're like, okay, well, I don't need to take these stupid trades that most people would take because I don't care about making hitting a home run. I'm just more so kind of trying to keep my profit engine going nonstop, essentially. So position sizing and risk management. Again, when you're sizing a smaller account, you don't want to be taking more than a certain number of trades at a time, because if you're allocating too much capital, you're gonna have too much to watch at a given time. If you're fully allocated on calls, for example, let's say you buy calls on like Nvidia, Google, Broadcom, Amazon, like you're directionally biased to the upside, right? If we get a pullback like we have the past couple of days, you can watch every single position of yours wash away pretty fast, right? Better to look at balancing your positions, perhaps like maybe take some bearish bets in conjunction with some bullish bets versus being so one-sided. Now, there are times to obviously throttle your trading and say, like, you know what? We've pulled back during the tariff tantrum last year, during the Iran war this year, for example, during COVID. There are times, as we've seen, where it makes a lot of sense to say, you know what? I'm going to go full on long, but you need to have a decent time horizon. Going too short dated, if you miss it by a week, for example, and you wash out and your portfolio blows up or loses most of its value, you're back at square one again. You can't really come back from that, right? Again, if you lose half your portfolio, you need to go up 100% just to get back to where you were before, right? So that's kind of how the math works. You need to think about it from that perspective. So sizing wise, you typically want to have, I have a little chart here too for position sizing. I'll just keep this here. I'm going to zoom in so I'm not showing too much of my materials because these are what I use to teach people. Here is another graphic for you guys. You can see over here account sizes and max position percentages, right? So let's say you have a 10K account, for example, 1% would be $100, 2%, $200, so on and so forth. You want to stay pretty much in this range, like 1% to 2%. And it doesn't sound like a lot because you're saying like, well, Nick, how am I going to make enough money to justify my trading overall? My time is valuable too. Yes, I understand that. But the thing is, your goal should not be to try and go from like 10K to like $1 million really fast. You should set incremental goals like, you know what? My first goal is to go from 10K to 11K, right? A 10% return, a very feasible goal, right? A very realistic goal, right? And so as a result, you might actually end up hitting it and feeling good about that. Versus if you're trying to hit this like crazy, outlandish, unrealistic goal of like 50K in like a month or whatever, you're going to be disappointed because, again, as I said previously numerous times, just like in the markets, expectations versus reality, right? Whenever you have high expectations in life and your realities are lower than those, you feel kind of sad or disappointed by the outcome. Versus when you have very low expectations and the reality is above that, for example, you feel much, much better overall, right? Think about a time when perhaps you got like a promotion at work and you didn't expect it. You must have felt like overjoyed. They're like, wow, incredible. I got, far more salary than I thought I would have asked for example, right? Versus maybe you get a promotion and they offer you like a much, much smaller salary than you thought you would get, for example. You might feel like demoralized because you expected too much. That's kind of the way that the human mind works. So going from there back to the main graphic, because I want to have some time for Q&A as well. Why going big is a surefire way to failure, right? So again, as I said previously, if you try and size too big too fast and chase larger returns too fast, it can work for sure. But the probabilities are against you because all it takes is one misstep and you're going broke pretty fast, right? And your account blows up and then you're done. That's it. You quit. So anyways, I'll leave a session one at this. Hopefully it was fruitful for you guys. If you have any questions at all, drop them in the comments in the video I'll post it on YouTube as well. Or just DM me over Discord. That works as well. And yeah, I know if you guys asked me about working with me one-on-one as well. I am fully booked right now until September. If you're interested, just DM me and we can discuss obviously timeframes, but that's a different discussion, obviously. Otherwise, I'll open it up now, guys, to Q&A. Any questions, guys? Any questions at all?
Yeah, Nick,
Alrighty.
this is great. Thank you.
No problem, man. Yeah, my pleasure. If you have any questions,
Yeah,
guys, at
I
all?
had some wild moves and stuff like that. Yeah, full disclosure, I trade probably 8 to 9% of my total net worth in these accounts.
Yep.
So, and yes, I have some wild moves, but nothing that's like gonna take my house or anything.
Yeah, and that's a very important point. Is like the whole objective should be like again, I said it numerous times, right? The whole goal should be to kind of elicit indifference as to the outcome, right? So taking risk where you're like, you know what? Obviously, you want to make money, but if you don't make that money and maybe lose a little bit of money, it's not a big deal. You're just like whatever, right? You want to avoid decisions that elicit risk of ruin, right? Risk of ruin is like blowing up your portfolio, right? I've heard of numerous fund managers that have blown up their funds just by taking just stupid risk, right? And it's like you already have so much in life. You might have a house and a family and an office and employees, perhaps, if you're a fund, and clients, and you're doing well and you're making a good living, but you just want more. You're just seeking too much too fast. And so what do? You take too much risk, and it goes against you. And all of a sudden now you got to sell your house. Your wife's leaving you. Your kids don't want to talk to you. Your employees are all unemployed. All your clients hate you and are suing you. Like you don't want that, right? So again, think about your account. And a good point here too, guys, on that note is treat your account like a business, right? Treat it with the same scrutiny as if you were a public company and every decision you make is public knowledge, right? Think about it from that perspective because it'll change how you make decisions. Would you be embarrassed by making a stupid trade where you're sizing too large? Of course. So kind of think about it from that perspective, and you got to hammer it home. I know not everyone will hammer this home right away. It takes oftentimes like blowing up maybe a few accounts, right? I've heard of numerous people blowing up 4 or 5 accounts of 5, 10K before they actually understood like, okay, next time I'm not gonna do what caused me to blow up my account. So you want to learn lessons from this as well. Like it's important to learn. If you can earn what you learn, even better, right? But the key goal is to learn how to grow a small account. And that's being responsible and picking the right positions. We can discuss it in a different session, perhaps psychology of it. We can discuss strategies. We can discuss looking for opportunistic trades, perhaps, right, and being patient. There are many different topics to cover in this segment, but I'll think about how to articulate my thoughts better. This way, we can kind of cover them in a more succinct manner because we have limited time. I'm not sure what the market's doing right now. I've been watching for the past 45 minutes, but any more questions, guys? So I think Mike posted in chat. I'm curious how you think about legging out of combos or spread trades. For example, the SPX fly I recommended. Would you leg out of the $7,300 puts you sold and keep the 7,500, 7,100 puts outright? Trying to understand what cases you would do that. So in that case, Mike, you would not close the trade out because what would happen is that by buying back those puts, you would increase your risk threshold dramatically. And it's all right, Willie. I wouldn't know, man. No big deal. You increase your risk dramatically because right now to buy back those positions on SPX would cost you second index. It would cost you approximately what is this? Oh, there it is. Okay. You'd be paying basically $34,000 approximately to buy back two of those contracts. So you can see why using strategies is so powerful. Like at the inception of this trade, the trade was SPX, July OPEX, $7,500, $7,300, $7,100 put flies financed by the 7,900, 8,000 credit spreads on the call side. The cost was $2 or $200 of overall cost. And the maximum upside here was $19,800 overall per position. So risking a debit amount of $200 for upside of almost 20 grand, right? Now, what was it, Mike? I think it was Mike. Yeah, what Mike asked was, should we be buying back the middle strikes? And the answer is an unequivocal no, because you would increase your risk from $200 per position to $34,200 per position. That's what happened, right? So obviously, if it goes in your favor more and we fall further, it can work in your favor, obviously, right? But you don't want to be de-risking a position like that. What could work instead, Mike, is Michael, hopefully you don't mind me calling you Mike, is if you sell off to like 6,800, for example, and your 7,500, 7,300 put spread is fully in the money and it's near maximum value as we approach expiration, then at that point in time, you would then close out the 75,000, 73,000 position, but you keep the 7,300, 7,100 position intact, and then hope for recovery back up into like the middle of that range, perhaps to close it out. That's kind of how you can leg out of it. Yeah, hopefully that helps a little bit. And Windmill Willie, as per your accidental hot mic, not a big deal, man. All we heard was that you made like $1,000 or something like that, and your wife is very proud of you. So that's it. Willie asks, I'm not sure this is a small account question, but a risk management question. Can you speak to the technique of not closing a spread by taking the spread on the opposite side? Not closing the spread. So I'm guessing, for example, what you're referring to is like you own a put spread, and instead of closing it out, you buy the call spread. I don't really do it myself very often, like only if I'm concerned about a binary event perhaps and I'm not at maximum profit. But I never really do that at all. And like my mentality is I'll just re-roll my position, right? So like I had put flies for Friday. I bought them last week for 85 cents. On SPY, I bought the 750, 730, 750, 740, 730, $10 wide put flies for 85 cents. They went to 290 yesterday, 295 yesterday. I cut those. I bought the 740, 730, 720s for Friday again for $1.27. I cut those today for two, I think it was 260. And I'm going to re-roll for Friday again, but probably not till tomorrow because of so a good observation and a good point for you guys as well. Maybe we'll get the last one we discussed before we cut off. But if your butterfly is at the middle strike already with numerous days till expiration and it isn't a very wide fly, you probably want to take it off and re-roll because the probability of us staying at that strike price for the next like 2 or 3 or 4 days into expiration is not very high. So therefore, it's sitting at the middle strike on the nose, like 3 days or 4 days in advance of expiration. You probably want to take it off because otherwise, if we move too far past the middle strike, or revert back down below the previous or your lowest strike if you're on a call side or highest strike if you're on a put side, that will elicit a less favorable outcome overall, right? Obviously, if we just hover there and doesn't move too much overall, and we sit at a middle strike, then it'll elicit a further gain as time decay kicks in over time. But that's not ideal typically. Yeah, that would be kind of like, well, no, a box spread would be when you're selling a put spread for a credit, as well as a call spread for a credit, same strikes crossing each other essentially, and net out, you should get some kind of small credit for holding the trade. The problem is that you have assignment risk the entire time, right? You can be assigned on the short put or short call because they're both in the money at the same time, essentially, right? That's why you might want to use a cash settled asset like SPX, for example, or NDX or XSP if you want to trade 1/10 the notional value of SPX. Anyways, guys, any more questions at all before we break off? We're at 50 minutes here, and I noticed the market's down like 70 points since I started talking. So, yeah, good observation. Well, yeah, definitely stay away from boxes on assignable instruments. 100%. Anyways, guys, hopefully you learned a lot here. If you have any questions at all, drop them in the YouTube channel comments or whatever. Ask me in Discord. I'm an open book. And manage your risk well. Have a great day, and we will talk again soon.
Thanks, Nick. Appreciate you.
Likewise, man. Take care.
Hey, man.